Michael Oliver just made a statement that stopped the entire precious metals community in its tracks. For those who do not know who Michael Oliver is, he is the founder of Momentum Structural Analysis, one of the most respected independent technical research firms in the commodity space. He does not sell bullion. He does not run a YouTube channel. He does not have sponsors or affiliations with dealers. He charges institutional clients thousands of dollars per year for his analysis. Hedge funds, family offices, and professional commodity traders pay for his work because his structural momentum methodology has called major turns in gold, silver, oil, and bonds with a track record that most Wall Street research desks cannot match. When Michael Oliver speaks, the professional trading community listens, and what he said this week should fundamentally change how you're preparing for the next 30 days in the silver market. Oliver stated that silver could see $10 to $20 up days, not $10 to $20 moves over a week, not over a month, single-day moves of $10 to $20 per ounce. At the current silver price of approximately $72 to $75, a $20 up day would represent a 27% single-session gain. A $10 up day would be a 13% move. These are not normal market moves. These are the kind of moves that happen when structural momentum shifts collide with compressed volatility, depleted liquidity, and leveraged positioning that is caught on the wrong side. And every single precondition that Oliver's methodology identifies for these extreme moves is present in the silver market right now, Wednesday, April 1st, 2026. I'm going to walk you through each precondition with the exact data that confirms it. Because Oliver is not making this call based on gut feeling or social media hype. He's making it based on the same structural momentum indicators that called the 2020 silver bottom at $12, the 2024 breakout above 30, and the January 2026 run to 121. His methodology works, and his methodology is now warning that the volatility about to hit silver will be unlike anything most retail investors have ever experienced. Let me start with what Oliver's structural momentum analysis actually measures, because it is fundamentally different from traditional technical analysis. Most technical analysts look at price charts. They draw trend lines. They identify support and resistance. They use RSI and Massey-D and Fibonacci levels. Oliver does something different. He analyzes the rate of change in momentum across multiple timeframes and identifies points where the structural character of the market shifts from one regime to another, not from bullish to bearish or vice versa, from low volatility to high volatility, from range-bound to trending, from compressed to explosive. His methodology does not predict direction as much as it predicts the magnitude and character of the coming move. And right now, his indicators are showing that silver is transitioning from a compressed low volatility consolidation phase into a high volatility trending phase, the kind of phase where $10 to $20 days become possible. The first precondition is Bollinger Band compression reaching extreme levels. When the Bollinger Bands on the daily silver chart narrow to their tightest width in a defined look-back period, it signals that volatility has been suppressed to unsustainable levels. Volatility is mean reverting. It cannot stay compressed forever. When it expands violently. The current Bollinger Band width on silver's daily chart is at its narrowest point since the consolidation that preceded the breakout from 29 to 121 in 2025. That previous compression resolved with silver gaining 317% over 12 months. The compression itself does not predict direction. It predicts magnitude. Whatever direction silver breaks, the move will be large. But Oliver's methodology goes beyond basic Bollinger Band analysis. He layers the compression data against the structural momentum of the underlying trend. Silver's long-term momentum, measured by price relative to the 200-day simple moving average at 56.93, remains firmly bullish. Silver is held above the 200-day throughout the entire crash from 121 to 65. Even at the absolute low, the long-term structural trend never broke. The compression is happening within a bullish structural regime. Oliver's research shows that when extreme compression occurs within a bullish regime, the resolution is directionally biased to the upside roughly 70% of the time. The other 30% produces a downside break that is typically short-lived before the bullish regime reasserts itself. The second precondition is the volatility index environment. The VIX is above 31 as of the most recent data. When the VIX is above 25, market-wide volatility is elevated. When it is above 30, fear is the dominant sentiment driver. Elevated VIX environments create conditions where large moves happen more frequently across all asset classes, including silver. But there's a specific dynamic that Oliver highlights for precious metals. When the VIX is elevated due to geopolitical risk, meaning the fear is about war and instability rather than domestic economic data, precious metals experience amplified upside volatility because they benefit from the same fear that is driving the VIX higher. The current VIX elevation is driven by the Iran crisis, the Saudi Arabia military base access grant, the Hormuz Strait disruption, and the approaching April 6th deadline. All geopolitical, all precious metals positive. Silver's upside volatility in a geopolitically elevated VIX environment is historically 1.5 to 2.3 times greater than its downside volatility. The moves are asymmetric. The up days are bigger than the down days. The third precondition is positioning extremes on both sides of the trade. Oliver's methodology identifies maximum squeeze potential when two conditions exist simultaneously. Commercial shorts at maximum concentration, speculative longs at minimum concentration. The CFTC-TOT data from March 10th shows exactly this setup. Commercial shorts at 45,444 contracts, representing 227 million ounces. Speculative managed money longs at 8,500 contracts, a 13-year low. The ratio of commercial shorts to speculative longs is approximately 5.3 to 1. For every speculative long contract, there are 5.3 commercial short contracts. Oliver's research shows that when this ratio exceeds 4 to 1, the subsequent covering move by commercials produces price gains that are 3 to 5 times larger than normal because there is no speculative selling overhead to absorb the buying pressure. The commercial covering hits a market with no sellers above. The price gap's higher. 227 million ounces of commercial shorts needing to cover into a market where only 8,500 contracts of speculative longs exist to sell into. When covering begins, the buying overwhelms available, selling within hours. The price does not crawl higher. It jumps. $10, $15, $20 in a single session. Because there is nobody selling to absorb the buying, Oliver's $10 to $20 day call is not hyperbole. It is the mathematical consequence of the positioning data applied to historical covering velocity patterns. The fourth precondition is the physical market disconnect, providing a price target above the current range that acts as a gravitational pull. Oliver's methodology incorporates what he calls structural fair value, the price level where the physical market and the paper market achieve equilibrium. When the physical market consistently prices a commodity above the paper market, the structural fair value sits at or above the physical price. The paper market is pulled toward that level over time. Shanghai silver at $79 to $81, India at 82 to 83, Tokyo at 107 to 127 all in, US dealer retail at 76 to 83 with premiums. The structural fair value implied by the global physical market sites at approximately $80 to $85 per ounce before accounting for the premium compression that would occur if COMEX repriced to physical reality. When the breakout from compression occurs, the price does not stop at the first dollar above the breakout level. It accelerates towards structural fair value. From 75 to 85 is $10. A $10 up day gets silver to physical market parity. And once parity is reached, the momentum from commercial covering and speculative reentry can push through 85 toward the Fibonacci resistance levels at 86.70 and 93.30. The fifth precondition is the catalyst density within the immediate timeline. Oliver's research shows that the largest single-day moves in commodity history cluster around periods of maximum catalyst convergence, when multiple independent catalysts fire within the same 3 to 5 day window. The combined effect produces moves that are larger than the sum of the individual catalyst impacts. The catalysts are not additive, they are multiplicative. Each catalyst amplifies the impact of the others. Look at what is stacked into the next 7 days. Today, April 1st, ADP private payrolls data and early Liberation Day positioning. Tomorrow, April 2nd, the Liberation Day tariff announcement with silver uniquely non-exempt among major metals. Thursday, April 3rd, initial jobless claims and tariff reaction trading. Friday, April 4th, non-farm payrolls drops at 8:30 a.m. into a market closed for Good Friday. Silver cannot react until Monday. Sunday, April 6th. The Trump administration's Iran deadline expires. Monday, April 7th. Markets open with NFP data plus Iran outcome plus weekend developments, all compressed into a single opening session. Historical compression gap opens average 1.5 to 2.5 times normal reaction size. With VIX above 31, the amplification factor increases further. 5 major catalysts in 7 days. A jobs report dropping into a closed market, a geopolitical deadline expiring over a weekend, a tariff announcement hitting the only non-exempt precious metal, and all of it landing on a silver market with maximum commercial short exposure, minimum speculative long exposure, extreme Bollinger Band compression, and a physical paper price disconnect of $10 to $22 depending on market. Oliver's $10 to $20 day does not require all catalysts to fire positively. It requires 1 or 2 catalysts to resolve in a way that triggers commercial covering. Once covering begins in the current positioning environment, the cascade is mechanical. 227 million ounces of buying meets 8,500 contracts of potential selling. The ratio is 5 to 1 in favor of the buyers. The price gaps because there are not enough sellers to absorb the flow. The COMEX vault condition amplifies the covering urgency. Registered silver at 76 million ounces, coverage ratio at 13.5%, 3 consecutive record delivery months. The April cycle lived with 9.9 million ounces standing. If delivery demand spikes during the same window that commercial covering begins, the shorts face simultaneous pressure from above, covering obligations pushing the price higher, and from below, delivery demands pulling metal out of the vault. The squeeze pressure comes from both directions at once. That dual pressure is what produces the extreme magnitude moves that Oliver is warning about. Brent crude above $100 after the 58% March surge, the largest monthly spike since 1988, creates an inflation backdrop that prevents the Fed from cutting rates to weaken the dollar. But the economy lost 92,000 jobs in February. Goldman recession probability 35%, Moody's 49%. The Fed is paralyzed. The dollar is strong on fear, not fundamentals. When the fear subsides, the dollar drops. When the dollar drops, silver moves. And the magnitude of the silver move in a compressed, leveraged, positioning extreme environment is what Oliver is quantifying at $10 to $20 per session. The Silver Institute's 6th consecutive deficit year at 67 million ounces means the supply side cannot respond. No new mines until 2033. Samsung locking up mine output directly. Mexico disrupted. China restricting exports. The supply that would normally dampen a price spike by flooding the market with fresh metal does not exist. The supply response time is 7 to 10 years. Silver can spike $10 or $20 in a day, and there is literally no supply-side mechanism to push it back down within weeks or months because the metal does not exist to sell. JP Morgan targets 81, Goldman 85 to 100, Citi 110, Bank of America 135 to 309. Every institutional target is above current price. The bank's own research says silver should be higher. When the covering starts and the price begins moving toward those targets, the research reports provide fundamental justification for the move. Institutional clients who read those reports see silver reaching their bank's target and add exposure. The research becomes a self-fulfilling catalyst that feeds the momentum. Oliver's track record on these volatility calls gives the warning additional weight. His structural momentum analysis identified the 2020 bottom in silver at $12. It identified the breakout above 30 in 2024 as the beginning of a new bull phase. It identified the structural momentum shift that preceded the run to 121. In each case, his methodology flagged the transition from compressed to explosive before the move occurred. He is now flagging the same transition in the current setup. The preconditions are met. The compression is extreme. The positioning is maximally favorable for a squeeze. The catalyst density is the highest of the year, and the physical paper disconnect provides a price target above current levels that the market will gravitate toward once the compression resolves. The practical implication for your positioning is urgent. If Oliver is right and silver produces a $10 to $20 up day within the next 2 to 4 weeks, the move will happen too fast to react to. You cannot see silver at 75, decide to buy, open your brokerage app, place an order, and execute at 75 if the price is already at 85 by the time your order fills. $10 moves in silver happen in minutes during squeeze events, not hours. The January 29th all-time high session saw silver move $13 intraday. The price opened at 108 and hit 121 in hours. If you were not positioned before the open, you missed the move. The same dynamic applies to the coming volatility event. If you are not positioned before it fires, you will be chasing. Chasing a $10 move means buying at 85, hoping it goes to 95. That is a much worse risk reward than buying at 75, knowing the structural fair value is 80 to 85, and the squeeze target is higher. Oliver is not telling you to buy silver. He is telling you that extreme volatility is coming. His structural momentum analysis is agnostic on position recommendations. But the positioning data, the physical market pricing, the vault depletion, the deficit data, and the catalyst calendar all point in the same direction. The volatility is coming, the compression is resolving, the $10 to $20 days are loading. Whether they fire this week, next week, or in April's remaining sessions, the conditions are set, and the conditions are the most extreme Oliver's methodology has ever identified for silver. You have been warned, not by me, by the data, by the positioning, by the compression, by the man whose methodology called every major silver turn of the last 5 years before it happened. Stack accordingly. Get ready. I'll see you in the next video.